The Dow is close to session lows, off 300 points. It's been a pretty miserable September for the markets. As you can see, the Dow off nearly 1%, S&P down more than 1%, and the Nasdaq down 1.25%. Look, we've had some latest numbers say home sales in August disappointed, new home sales, and consumer confidence also missed estimates by more than expected. So, what's going on? Let's get the read from Bullseye Option Chief Market Strategist Alan Nuckman. Alan, you know, it used to be that bad news was good news if you want to follow that line, because it meant that the Fed would be less inclined to raise rates because the economy was damping down. But now just, you know, bad news is bad news. The economy is slowing down. Is that right?
Well, you can look at it differently. The economy is so strong that we're higher. We are here for longer. We're not higher, but we're near our terminal rate, but we're holding at this high level for a longer time because things are so strong. So a couple things I want to mention here. The good news is that a 1% move now is 50 points or 300 points in the Dow. So, you know, we're at loftier levels. We're at swing lows that we've seen for the near term for the summer, but we're not making new relative highs in the volatility. The VIX, the volatility measure, has been below 20 for 4 full months. So there are some positives here, but I don't want to forget about the UAW. My dad is a retired UAW member. I'm from Michigan. I went to Michigan State, not the Wolverine School, but Michigan State. And they do innovate. And the first thing I'd tell you is look at the Ford truck. There's not one person that is not in love with the Ford truck, and that's big business, and that's helped a lot of auto workers.
It certainly has. The Ford F-150. I think it's the most popular truck in America. But I want to get back to the markets quickly, Alan. Jamie Dimon, by the way, also kind of casting a bit of a pall over the exchanges today, saying that he believes that interest rates may need to go further higher to tamp down inflation. Do you think he's right?
Well, inflation's cut in half. I'm not going to argue with Jamie Dimon. He's the man. But what I see here is a pause in stocks. We've seen the stock market. We're essentially sideways between 4,400 and 4,600 in the S&P for 3 months now. We're testing the low end of the range. But we are coming to a potential catalyst. We haven't had any fundamental facts over the last month of September, which happens because we don't have earnings. Earnings start again in October, and that can drive the markets. And with all of this and record rate hike path, we're only 11% off the all-time top, and yeah, we're 7% off the summer top. But, you know, we've been in a buy-the-dip market until proven otherwise in 2023, and I still see a lot of positives, and the positives are there, and that's why the Fed is still holding rates and actually reduced the number of times they're going to cut.